Welcome to RBC's Markets in Motion podcast, recorded April 20th, 2026. I'm Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, despite the strong rebound in the U.S. equity market, investor sentiment remained subdued last week. This signals to us there is room for U.S. equities to run by climbing a wall of worry. Second, 1Q26 reporting season got off to a strong start last week, evidenced by a sharp pickup in the percent of companies beating consensus earnings forecasts and reassuring commentary from companies. Third, other things that jump out in our latest updates include strong outperformance by large cap growth and growth-oriented sectors in April, the low-quality burst of leadership in small cap, and strengthening inflows to the U.S. amid outflows from Europe. If you'd like to hear more, here's another 5 minutes. Digging in a little more to takeaway number one, subdued investor sentiment. We saw this last week in terms of both data and conversation. On the data side, net bulls on the weekly AAII Equity Investor Survey were at minus 11.1% as of April 16th, down from the prior week, and on the 4-week average, still at minus 13.5%. Both the weekly data point and the 4-week average also remain slightly more than one standard deviation below the long-term average. That's ultimately good news for the S&P in our view, as levels of net bullishness between -1 and -2 standard deviations below average tend to be the sweet spot for S&P returns on a 12-month forward basis, with an average gain of 15%. We're also keeping a close eye on forward PEs for the Russell 2000 and S&P 500. Both are moving up, but still have room to run before hitting past highs, as long as the de-escalation, U.S. economic and EPS resiliency thesis persists, an idea linked in part to the idea that the war's duration will be short. On the conversation side, we spent several days last week in meetings with long-only U.S.-focused and U.S.-based equity investors outside of NYC. While we wouldn't describe these investors as bearish, they were clearly taken aback by the sharp rally in the major U.S. indices and the quick move to all-time highs. The main concern generating this state of disbelief seemed to be that stocks were simply pricing in too much optimism, with potential ripple effects from the Middle East and energy market disruption still clouding the outlook in terms of potential cost pressures on businesses and consumers and demand and sentiment impacts. We did not encounter concerns about Fed hikes or expectations of severe hits to U.S. economic growth or recession. While clients were interested in getting our take on private credit, we also found that most did not see it as a systemic risk. And while we didn't see evidence of euphoria regarding the AI theme, we also didn't sense anything resembling the AI anxiety that emerged last fall, i.e. bubble concerns, or to start the year when major job loss fears were a topic of conversation. On AI, there was more interest in discussing the CapEx cycle. Our take was that weak levels of spending by public companies outside of the top 10 market cap names highlight one way it could be elongated. Also, surprisingly, the investors we spoke with were keen to talk about why U.S. equities had been so resilient since the Iran war began. We highlighted our survey work from early March, which illustrated how many sectors and industries were seen as having low exposure, and our work on U.S. non-U.S. valuations, which showed how the U.S. equity market had lost its valuation premium as the war began. Moving on to takeaway number 2, the strong start to 1Q reporting season. So far in 1Q26 reporting season, which has admittedly been heavily skewed by financials, the percent of companies beating consensus in the S&P 500 on earnings forecasts is tracking well above last quarter's levels. Overall commentary has also been reassuring. Uncertainty has been a hot topic in macro discussions. One company noted customers were cautious but engaged, and another said no pause in activity has been seen, as was the case around tariffs. On the consumer, companies highlighted the resiliency broadly in the various spending, credit, and delinquency stats they track. One company jumped out for their comment that they have seen that it historically takes consumers several months to reduce their spend levels on other categories to adjust for higher oil prices. And on war impacts, a few companies stood out for their observations that impacts had not yet been seen, while others alluded to the idea of them showing up in the future. One consumer goods company noted they were planning for inflation impacts, but they had a hedging program in place, generally 6 to 12 months, which gave them visibility in the near term. Another noted the longer the war goes on, the greater the 3Q and 4Q impacts would be. And on private credit, we suspect that what we read contributed to the fairly calm tone we sensed among investors on this issue in our meetings last week. One big investment bank explicitly said they don't see private credit as a systemic risk, but also caught our attention for their comment that in every credit cycle, there's almost always an industry that surprises people for getting caught up in it. And we'll wrap up with takeaway number 3. What else is jumping out on our work right now? First, on positioning, we're struck by how strongly growth has beaten value, and the biggest market cap names have been beating the rest of the market in April. As a reminder, we've been biased in favor of this cohort as we think it has the best earnings growth story, and lingering impacts from the war in Iran seem likely to keep that narrative a while longer by serving as a headwind to the rest of the market. Second, on small caps, while the Russell 2000 has been outperforming the S&P 500 recently, but not the Nasdaq 100, it's been no comfort to small cap investors who are lamenting the return of low-quality leadership in the Russell 2000, something we've also seen evidence in very recent trading. And finally, on flows, 2 things stood out to us on the weekly EPFR flows update. First, we're seeing improvement in retail passive flows for U.S. equity funds after a brief period of outflows, suggesting retail fatigue contributed to the recent 9.1% drawdown in the S&P 500, and better spirits contributed to its subsequent rebound. We do question whether retail will continue to be a strong buyer of the dip, given the pressures of high gas prices and the deterioration in stock market outlooks that we saw in the recent Conference Board consumer survey. And second, we've seen improvement in U.S. equity flows broadly alongside clear outflows from Europe, confirming to us that part of the story of U.S. resiliency of late has been the incremental weakness seen for Europe. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.